So we talk a lot on this channel about how we use the infinite banking concept to put more of your money working for you. And so one of the ways that we need to do this is by putting your capital to work. And I love using real estate. I have lots of clients that are real estate investors, and I love using real estate as an example for how we can use capital to our advantage. Hey, if you're new here, my name is Kristyn. I'm an authorized infinite banking practitioner, and I help Canadian families and business owners find peace in their financial lives and live the abundant lives that they were born to live by taking back control over their finances and redirecting more money back into their pockets. So, this week, I want to get into a little bit more about how we use the infinite banking concept in alternate investments and how you can use it to actually put your money to work. So, the first part of having a policy is funding it, and we take over that banking function. But what if you don't have debt that you're trying to pay off? What if you have excess capital sitting in this policy? One of the best ways to me that we can deploy that capital is by investing in things like real estate. So today I'm bringing in my friend Zorya. She is a multifamily real estate investor. She has over $28 million in assets between Canada and the US, and she's helped many, many families get into the multifamily market. And she really is just a wealth of resources for how to get started and how to navigate the especially multifamily real estate investing. I'm so excited to have her here. So, welcome, Zoria.
Thank you so much for having me.
So, how long have you been into real estate? I assume you didn't just jump right into multifamily.
No, it's been a while. So our story started, my husband and I, like we were both earth engineers by trade. We went to university together, both in materials engineering, and that was really our main focus for throughout university and for several years after. We just like focused on our jobs. And it wasn't until I really got my PN that I started like looking at other things. We started like really realizing that our plan at the moment was that we would be just working at our jobs for the next 40 years. And yeah, and that didn't really excite me. I wasn't really that passionate about what I was doing. I was good at it, but I wasn't that passionate about it. And yeah, so like basically I got reached that goal of getting my professional engineering degree, but then we started exploring other things like other investments, other maybe businesses we could start, like just started exploring all sorts of different things. And yeah, we really didn't know much about real estate investing at all. We had purchased our condo, but we didn't know anything when we were doing that. We made all the mistakes with that purchase. Luckily, it all worked out fine, but yeah, we wouldn't have bought that condo if we knew more at the time. And so yeah, we were at this point that we did a lot of exploring, and what really made gave that like our aha moment was reading one of Robert Kiyosaki's like Rich Dad Poor Dad books, and it was called Retire Rich, Retire Young. And like we were just into just listening to a lot of audiobooks at that time. But that one really gave us that idea that owning real estate assets is like a foundation to like how most millionaires, billionaires have made their wealth is through real estate. Um, and through businesses. And yeah, we didn't really know too much. We started exploring. We're in Edmonton, and I remember thinking, like, I wonder if anybody in Edmonton invests in real estate. Like, I just didn't know too much about it. Hadn't never rented before. Like, it was just, basically went from living in my parents' house to living in a condo that we purchased. So, yeah, it just opened up this whole new world. There was, obviously, it was a huge network of real estate investors in Edmonton. And at the time, this was 2013, it was actually a really good time so we thought to invest in real estate. And so we just got educated and dove right in. We started with two single family homes. At the time, we had like a mortgage on our condo. We basically refinanced it so that we could create a HELOC, a home equity line of credit. We used that money to put down payments on two properties. So that was how we initially got started. After that, because we ran out of our own money and we started partnering with other people. So they would bring the capital, we would do the work. We bought a few more doors like that. And then again, it started getting a little bit harder for our partners to qualify for residential mortgages. We were at four mortgages ourselves. So that was the time we started transitioning and thinking about other ways that we could keep growing our portfolio. And that's when we got into commercial real estate. And it's a little different financing side, they look at more of the income that the building is producing rather than your own income. So actually, the more you buy, as long as you buy right, you can actually keep qualifying and it's easier to grow like that. So that's when we started, yeah, buying small multifamily new builds in Edmonton. We got a sixplex, and then the next year, two more sixplexes and an eightplex. And then after all that, we were at probably about 10 million in assets in Edmonton and started exploring into the US. So that's when I got involved with some other partners and we purchased 144 units in Houston, Texas.
Wow.
And I've been managing that. That's been a big project of renovating that complex, but I've been doing that for the last 2.5 years, focusing on that project. So, yeah, that's in a nutshell how we've grown to where we are. Yeah.
Wow. Okay, so let's back up for a minute. So when you first got started, you said that you bought two single family homes, right? You did
Yes.
that with your HELOC. So you leveraged the equity in your current house
Yeah.
and you were able to use that for down payments. Now, did the banks have any issues with you using your HELOC
Not
to
at all.
qualify? No.
No.
So that qualified for a down payment.
Yeah. Yeah. Again,
Okay.
because we were like basically two young engineers. We were like what we were taught at the time was to like pay down your mortgage quickly, right? So
Mm,
we were paying it down. And so after 3 years, we had probably 120,000 that we could access. Um,
okay.
and so yeah, we were able to just, yeah, the mortgage product we had at the time wouldn't allow us to pull it out, so we had to refinance it into a different product. But yeah, no, that it's done all the time. It's kind of the simplest version of the Smith maneuver, which is basically pulling out of your HELOC, and then once you do that, that interest is actually now tax deductible and
Hmm.
versus your regular interest payments on your own residence are not. But once you convert it and you're using that money for investment purposes, then it's tax deductible. And yeah, so that was the easiest way to get into two more properties and kind of get that initial experience, which then was enough credibility for like other people to partner with us and we could keep growing.
Yes. Okay. And then when you started with those two homes, what were your biggest challenges that you faced when you were starting?
Mm,
Was it in the purchasing of the home or was it like in the management of it after? Did you have any challenges there?
we really didn't have that many challenges with those first two. I would say the challenges came a few years into owning them because we got like educated. We joined this real estate investment network, and we right from the beginning we knew that we needed the right team. So we got a really good real estate agent, a bookkeeper, a property manager right from the beginning. So all of these and a good lawyer. So all of these people really helped us buy right and set up our systems well from the very beginning. The challenges began with those first two properties. Kind of a couple of years later when the market turned and rents dropped. And so the rents dropped about 25%. But luckily we bought right. We had cash flow initially, probably about $400 per property. And but yeah, when then rents dropped by $400 and then so at least we were break even. But so it was a little bit more challenging, but we were, better than most because we had that cash flow going in.
Yes.
Yeah.
And I love what you said about building the right team because I mean, I don't know how familiar you are with my story, but when we bought our current house, we couldn't sell our previous home, and
Mhm.
so we decided, oh, we'll just rent it out. And it was a huge mistake. It was in a bad area. That's why we wanted to move. And so it only attracted a certain type of person.
Mhm.
And even though this person was vetted by a neighbor and he was also his employer and it was someone that we trusted, everything went south really, really quickly. And we ended up with a trashed house. And I just have like the horror story of horror stories. And I know a couple other people that were in the kind of similar boat that were all trying to sell around the same time and couldn't. So we ended up doing the rental thing, but we all did it wrong. And we
Yeah.
tried to do it on our own. And um,
Yeah,
yeah.
that's the accidental landlord. That's how a lot of people do get started. They're like, yeah, yeah.
And so when you're looking for a team, that obviously comes into play when you're looking at your cash flow too, is how much you're paying this team. To
Hmm.
me, I would think a property manager would be the biggest key to making sure everything is working, to getting the right people there and not having to, be up in the middle of the night and fixing plumbing problems and all that kind of stuff.
Yeah. And we were, yeah, lucky that through this network, we got connected with really good, just another couple that was growing their property management business. They were also investors, so they knew, and we could trust them to make decisions. And yeah, they were great for many, many years. Because we knew, at least we knew enough going into it that was like we can either focus on growing and like learning how to raise capital and how to partner with people, or we can learn about landlording because we knew that was a big piece of it. But we're like, no, we're going to give the landlording side, like property management side, to a property manager, kind of learn from them, but just focus on the capital raising side and figuring out how to keep growing our portfolio.
Okay. And did you find that you take over any of that landlording
We
as you
have taken over,
progressed?
yeah, we have taken over it now. Just this past year, we took over basically 12 years after we started. Now that both of us, like I skipped over this important part of the story, but yeah, in 2017, I stepped away from my engineering job and haven't been back. So I've been full time into real estate investing and our running our business and portfolio for what, yeah, the last almost 9 years. And then my husband stepped away from his engineering job 2 years ago. And so
Nice.
because of we have a little bit more time now and flexibility, we've taken over the property management side of things. And because we were working pretty closely with our manager before, it wasn't too much of a jump to take it over.
Okay. Um,
Yeah.
so how did you kind of make that leap? Like what made you jump from the single family homes? It sounded like you kind of progressed, little by little, like maybe a duplex. Kind of walk
Yeah,
me through that process, like where you started versus how you got to where you are now.
sure. Yeah, so our very first properties were half duplexes because we wanted like the smallest property that we could buy that we could control fully. They had no condo fees, not part of any condo association. So, and that was a good choice. And then we bought a couple of, yeah, we bought another half duplex with a joint venture partner, and then another, just a small single family home with a joint venture partner. Then we progressed to well, one more house with a joint venture partner. Then we did a new build, which was a house with a in-law suite and a garage suite, or like a laneway house. And so that was, yeah, now we had like 2 units in one property. And we liked that. That did cash flow a lot better. We also, yeah, got a good price at the time for that construction. But yeah, then we got to that point where it was getting tough for us to qualify for mortgages and tough for our partners as well. Just the lending environment just keeps getting tighter and tighter. So we wanted to, yeah, do something different. And we knew that multifamily commercial financing was how most people grow bigger. And once we actually looked into it, we found that, um, yeah, where on the residential side, they might be able to get one more. On the commercial side, we were able to qualify for a lot more. So we could have now buy over a $2 million property.
Wow.
So yeah, and then it took a while to kind of find the right first property, and I'm glad that we like took that time and didn't kind of get into it too fast. We got educated about how it all works because it's completely different with the financing and how you even go about finding a property, how you look at the numbers. That's what all I teach now to people that are in that position. And yeah, we ended up, our very first multifamily was a new construction sixplex. which was actually three residential properties. So three suited townhouses. So like basically three townhouses, and then each townhouse has a one bedroom suite beneath it, but it was all above ground. And but we knew that even though they were on three titles or three residential properties, we could put a commercial loan over the whole thing. And so it was a really nice sweet spot between having a residential property, like residential taxes, residential insurance, which is actually cheaper, but getting commercial financing, which we could qualify for. And
Mm.
so yeah, we that work project worked out really well. And so we just kind of repeated that four more times. And that's how we grew in Edmonton. Yeah, and we just continue our looking for those types of projects to purchase.
Nice. Now what do you find when someone's coming in and looking for help with this? What do you find like new investors are find to be like the biggest challenge or the maybe the biggest mistakes that they're making when
Like
they're
when they're
looking at
brand new to
getting
real
started?
estate, brand new to
Yeah,
real
so
estate.
let's start there. So if
Yeah.
someone's brand new to real estate, I know you work with multifamily purchases.
Mhm.
Let's maybe back up. Who would be the ideal people to work with you and be part of your program?
On that side, ideally, it is people who have a little bit of experience with real estate. It's multifamily has always been considered more of an advanced strategy. And it typically does make sense once you can't qualify for residential mortgages anymore, because there are lots of positives about residential mortgages. Like the biggest one is you don't necessarily have to cash flow. The lender is not going to like ask for a cash call. Um, and like, as long as you make the mortgage payment, you're good. But commercial side is a little bit different, that they're reviewing your portfolio every single year, and you have to make sure that you're performing well. Anyway, so yeah, there's for the ideal client is people who have some experience in real estate and are just looking to scale. But that's not to say you can't get started in multifamily. There are people who are um, just getting into it. Maybe they own their own house and they're just like, no, I want to skip the residential side and go straight into, say buying a sixplex. That is possible, but the thing you need on the commercial side is net worth. So if you don't have too
Mm,
much, but if then that's where you can build that up by owning a small residential portfolio.
okay.
So, but yeah, we work with a lot of just professionals, nurses, doctors, engineers, accountants, all people who are like working and they don't necessarily want to do this full time, but they'd like to option to retire early. They'd like to have some additional income coming in. And some are just doing it for the very long term. They want to pass it down to their kids, or they just want to have a more comfortable retirement and just have options. Yeah. And so it's a very possible to do that and buy these multifamily properties while you still have, full-time job.
Okay, so your net worth doesn't have to be rental properties. In other words, it could be just your physical net worth from
Oh
your
yeah.
income
Yeah,
or
your yeah,
whatever,
your
your
income,
personal
equity,
assets. Yeah,
equity in your home, your other investments, cash.
that's
Yeah.
okay. And so when
Yeah.
people are coming into, let's start just they're brand new to real estate, what do you find the biggest mistakes are that people are making? Probably what I did with the
Yeah.
accidental landlord.
Brand new to real estate. Yeah, I think maybe just jumping into it too fast without getting just even understanding what your options are, just getting a little bit of education first. And like yeah, just getting connected with the right mortgage brokers, the right realtors, and really the other mentors, because um, yeah, you want to really get some advice from someone who's not biased and who's kind of done what you've done before or done what you want to do. And so I think, yeah, that's the biggest mistake, people kind of rushing into it and not doing enough due diligence and um, and not really understanding the market. Right in
Mm,
Edmonton right now, I think a lot of people getting into the market for the first time are going to find out in the future that they've overpaid. because it's very much a seller's market. It's kind of a boom time right now, and so not really understanding what you're getting into. And so, and that was what we know how we started too, but like we survived still, even buying in 2013, 2014, which was also a very similar time as now, where like rents were up. Everybody was buying real estate. Edmonton was a hot market, and we fell into that too. Like, oh, great, Edmonton's a hot market. We're going to buy, but hot market isn't necessarily when you want to buy. You got to be very careful. So that's the mistake, kind of guess, not understanding if it's a seller's market or a buyer's market.
Okay. And then looking for, you said that you worked with mentors and finding that team. How would
Mhm.
somebody find these people? Obviously, if they're in your area, they can speak with you, and you can definitely help in your online space as well with the multifamily. But if someone's in
Yeah.
another area, another
Mhm.
province, how would they find the people to help them?
The best thing is like look for real estate investor events. Almost in all major cities, areas, there's like free or low cost events that you could go to meet other real estate investors. And like even when I'm exploring or looking to grow in other markets, like in Houston, the thing I'm going to do is just start going to conferences, start going to on bus tours, just other meetups with other investors to start building that network. And you have to just start talking to other people and learn about the market and just talk to as many people as you can about what they've done. And you can start learning that way of what works, what doesn't, and just, yeah, I would just take your time to do some research because there's so many real estate paths you could go down. This, we've done just kind of the traditional buy and hold and then buy and hold multifamily. But yeah, people start getting into flipping or doing like burrs where you renovate and then hold. There's so many different strategies, right? So take the time to
Hmm.
figure out what best fits your scenario, like what your resources are, how much time you have, and what your strengths are. So yeah, I
Okay.
would just go to associations. Like in Edmonton, we have the Edmonton Real Estate Investors Association. And like in Calgary, they have similar stuff. And probably in any market.
Okay.
Yeah.
Okay. And then in terms of capital, um, because I feel like that's one of the big things. I was on one of your webinars, and you said how it's often that's one of the limiting mindsets that people give themselves is I can't afford that. I don't know how to
Yeah.
do it, and I can't afford it. So we've talked about the how you build up into building the right team and talking with other people and figuring out your market. But where does that capital part come in? Like
Hmm.
how do you get, because I know there's a lot of creative ways that we can start looking for that capital, right? You mentioned not having to use your personal capital anymore. You were using partners.
Yeah. Yeah, there's all sorts of ways. There's an abundance of capital, right? And when investors run out of their own money, they either start going like creative financing or creative strategies, and that could include like where the seller is helping to finance, like seller financing, agreements for sale, um, yeah, or joint ventures is a kind of creative strategy. Which or you start, yeah, partnering with other people and raising capital. As also, oh yeah, I wouldn't really recommend it, but promissory notes, basically like private financing, um, yeah, all sorts of ways that you can do it. And so yeah, it is a wall that most people get to. You kind of run out of your own money. And I don't think the best strategy is to just save up more money to buy another property. Like that's going to take a really long time. There's a ton of people out there who want to invest in real estate that don't have the time or the desire to do the work, right? And so most people have those people in their network, and you just need to kind of find the right people who want to get involved, and you just partner and you buy a property together because in most cases, you can do more together than you can on your own. So you pool your resources and you can continue growing. Yeah, and we found that's a lot easier to do on the multifamily side because we can structure it in a way that we can bring in a few different investors and they only have to bring the money. They don't have to qualify for the mortgage. and they can kind of come in with whatever capital they have. Versus on the
Okay.
residential side, we were always looking for one partner who could bring all the money and qualify for the loan. So that was a
Mm,
little tougher to do. Yeah.
right. So when you're talking about multiple people, is that like a real estate investment fund? Is that kind of what how that works?
Yeah, like we're not setting up like a mutual fund, like MFT, a mutual fund trust or anything like that. It's just a simple corporate structure. We just bring in investors as shareholders, and we all own the property together. And everyone's shareholders of the company, and it's a brand new company. And that company owns the sixplex, and that's all that that company does. And so, yeah, it's just easier to bring people in through that method. And even if they really needed to get out, they could sell their shares and get out. We don't have to sell the whole
Mm.
property to make a move people around.
I love that you mentioned corporations because I was going to ask you how you structure these as far as corporations.
Hmm.
Um, I've heard that you should have every door as its own corporation. So
We
maybe not,
have
maybe
each,
door is
yeah,
the wrong, but every
yeah,
property in its
every
own
building,
corporation. Yeah.
each building we've put in a separate corporation. Yeah.
And then you would have
So
like a holding company that owns all of the shares of all of your corporations, right?
of all of our shares, yeah, all of our
Yes.
shares are owned by our holding company.
Right.
Yeah. And especially since we have different partners involved in all of them, it just keeps it nice and simple. And so we just have a separate company for each one. So, yeah, keeps it simple, a little bit extra administration annually when it comes to like our accounting and legal, but I like that it's nice and clean and separated.
And that level of protection too, just for your own family and your investors' family, is that it's not directly held as a personal asset, right?
Yeah, exactly. Yeah.
Okay. Um, so we had, um, I have clients of mine that, several clients that are using their insurance policies that, they start with this infinite banking concept.
Hmm.
And they're using their insurance policies as ways to get into real estate. I have real estate investors that have maybe flipped a house and they take their profits from their house and put it their um,
The
into their
policy.
policies.
Hmm.
Yeah. And then they can take out a policy loan for their next flip and they don't have to make any payments on it. And they love that it doesn't show on their debt ratio, doesn't show on a credit report, anything like that. It's a completely private thing. Is that anything that you find um like do you use that or is that something that's talked about with real estate investing?
Yeah, like when we first started, exploring different types of investments when we were young engineers, we'd also, at the same time of kind of getting into real estate, we stumbled upon the infinite banking system. And I don't know how we originally got connected with someone who knew about it, but yeah, we kind of explored that. We ended up getting a policy on myself. So this was over 10 years ago now that we've had this policy. And initially, it's like you have to really like wrap your head around how this works because it's like, definitely nothing you're taught in school. And but in the end, it's been good for us because it's kind of been a forced savings account, right? Our policy requires that we pay into it each year. But it's manageable. But it's nice to know that we can then pull out of it, like pull a loan out. And initially, we were just kind of building it up, like letting it do its thing. And we got to some of those milestones where like we had access to more than we had ever put in, which was a nice place to be. And yeah, it was nice to just always have there as a backup because doing all these transactions, especially when we got into multifamily and we were raising capital, um, there's always a possibility that someone decides to, not sign the agreement in the end and they've like pull out at the last minute. That doesn't happen very often, but there's that chance of that happening. And so we always have our own lines of credit, our infinite banking policy as just additional capital that we can access just in case. And in real estate, you never know what could happen. Yeah. So when once you keep growing bigger, there's chances that you suddenly need, 50,000 or $100,000 and you just gotta get it quickly. And so we like that. Yeah, a couple times we did have to pull from it. And I like that, like if you're below 50,000, it's pretty easy to just pull from it. Like you put in a request and like the money gets transferred electronically and you've got it. And so we like that once it had nothing to do with our investors, but um, our financing, we weren't able to get the financing we needed in time before we had to close on our brand new property. So we had to go with a different kind of bridge financing, which wasn't as large. So we basically had to come up with additional capital. Instead of the 15% down that we were planning, we had to come up with 25% down
Mm.
just suddenly. And so yeah, we were able to just pull from our policy and help contribute to that those at closing. And then once we refinanced with our other mortgage, we back up to that 15% down or 85% loan to value, we could then pay back our policy. So it's just another nice source of capital. And which is, the interest rate is not bad at all. And the nice thing is like there's no interest payments that you have to make on it. Like even now we have an outstanding loan. We'll pay it off, but I'm not too worried about it because that like the policy almost pays the interest. It's just so yeah, we want to pay it off, but it's not we're not stressed about it. Like if we never pay it off, that also could happen too. Like it's it'll
Yeah,
just
it's a
come off.
completely, it's so hard for people to wrap their head around the idea of borrowing. You think you're borrowing your own money and you're not, you're borrowing the insurance company's money. But
Yeah.
then people get hung up on an interest rate and don't realize that the amount of interest that you're paying is so little compared to what you would pay on even a HELOC because
Hmm.
it's only charged to you once a year. That makes all the difference. And the control of not having to make those payments every month and
Yeah.
letting it ride for as long as you need to, just to have that flexibility.
Hmm.
To
Yeah.
me,
Yeah.
that's
That's
worth
huge.
whatever cost there is anyway, but it's cheaper, less expensive than it generally is to use the bank's money anyway.
Yeah. And at the same time, like the policy's still growing. It's still in growing at the same time you've used the money. Not as fast, I don't think, but
It does
yeah.
actually. Yeah, yeah, it's still
Yeah.
growing even though your policy is even though you're loaning it, it's still growing in the background. So
Yeah.
it takes a bit to kind of wrap your head around, but it's almost like having a house in the market. Your house is building value as the market
Hmm.
increases. You're increasing equity in that house. And so even when you borrow against it, your house is still
Yeah.
in a decent market. I know we're kind of all over the place right now, but in a normal market, your house is increasing in value all the time.
Looking
So
percent value.
it's
Yeah. It doesn't matter that you've pulled out some of that.
yeah,
Yeah. Yeah. It's almost somewhat to a HELOC in a way.
it really is. Yeah, with
Yeah.
a lot of advantages to using it. But and the control to me being the number one reason because it's so
Mhm.
private and you get to control how you're using it and nobody's asking you. Did you have to answer any questions about what that cash was going to be used for?
No, yeah, no questions. It's like your money. It's like pulling it from another bank account, right? It's like no questions
Yeah.
asked. Here's the money. That's and yeah, you have to start paying interest on it. But yeah, I think it was like 6.2% when we pulled it out. It's not that bad. It's way cheaper than if you had to go to like a private lender, which would be like 10 or 12%.
Yeah.
Um,
Yeah,
yeah.
exactly.
Yeah, so yeah, and it doesn't show up on your credit report, which is nice, but we do add it to our net worth statement, so that's nice.
Yes.
Yeah.
Yeah, a lot of people don't realize too that it still sits as an asset on your bank statement. If it's
Hmm.
in a corporation, it sits as an asset on that corporation's balance sheet.
Yeah.
So
And like as yeah.
so many
So
good
it actually
reasons to use
helps
it.
us qualify for commercial loans. So
There you go. I hadn't even thought of that, but yes, exactly.
hmm.
So awesome. Okay, well, if
Yeah.
somebody wanted to work with you, wanted
Oh.
to learn from you about how to do multifamily, first of all, you can help in any market, right? They don't have to be in Edmonton or Calgary to work
No,
with
we
you.
are like obviously like our expertise lies the most in Alberta. And but yeah, we I just started a small group mentorship program that, well, the eighth group that I've started. We just started cohort 8. And we have investors all over Canada, from Ottawa, Halifax. And so a lot of them are considering investing in Alberta because of the landlord tenant laws are a lot better here as a, when you're a landlord. But yeah, it's mostly my program applies to all Canadians and like Canadian commercial financing. And I also can help if people are looking into the US as well. And so, yeah, a lot of Canadians are considering that too, like kind of diversifying out of Canada. I know we're looking to grow there as well, um, so that yeah, we're just not all tied in one place.
Diversity with anything is the key, right?
Yes, yeah,
Okay, so I'll pop your link in the description of the video and we'll have information so people can get in contact with you if that's something that they're thinking about.
yeah.
But thanks so much for being here. I appreciate the conversation and I think this was so interesting and yeah, I can't wait. Hopefully one day I'll work with you too. We're not quite ready to dip our feet back into it. We had such a bad experience, but we do want to get back into real estate investing. So
Yeah, I know. It's at first the first property is so important, right? You don't want to have that bad experience. But yeah, yeah, with the right help and guidance, like you can have a good experience. Yeah.
Yeah, for sure.
Mhm.
All right. Okay.
Yeah.
Well, thanks so much. And we'll leave your information below for anybody to contact you.
Sounds great. Thank you
All
so much for
right.
having me on. It was great
Thank
talking to
you.
you.
Thanks so much for joining. If you found this episode helpful, please give it a like and hit subscribe. When you're ready to take the next steps with infinite banking, click the link in the description to access my free resources and book a call to start. Your future self will thank you. Until next time, live free.